Well, that escalated quickly. This 2 day sell-off, one of the biggest sell-offs that we've seen in multiple years. I'm gonna break down the pattern from a technical perspective to see, okay, what is it? What opportunity is there now? Are we going to just keep plummeting down? Where are we going to find some support? Are we going to bounce? What do the technical charts show us? And where can I take advantage of this? Make this sell-off work to my advantage going forward from here, and as well as what's driving this and what could drive the bounce if we do get one. So let's go ahead and get started. Today is Monday, February the 5th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. Keep coming back day after day for more. Subscribe to my YouTube channel by clicking that subscribe button, the red subscribe button right down below the video there. You can do that right now while you're watching. Also, while you're down there, click the thumbs up icon. That lets me know that you liked the video today, that you got something out of it, and number two, that you want me to do it again tomorrow. So click that thumbs up there. Scroll down further, comment on anything that stood out to you. What did you learn from today's video? Comment on that below. Also, remember to join my daily email newsletter that I send out in conjunction with these videos that has time-stamped hyperlink summaries of everything we talk about. You can see the link down in the description below. Follow me on Twitter for more content, so more of this stuff that I put out there. A lot of times tying together videos with relevant topics, relevant things that we're talking about in these videos that I find out there. So follow me on Twitter for that. My handle's up there at the top, at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Finally, join the Market Outlook community on Facebook. You'll see the address at the top as well. There's also a link down in the description below to click and to join. All right, well, let's take a look at the S&P 500 right off the bat here. And no shocker that the short-term sentiment is extremely oversold. Momentum line down just above the 5th percentile, near-term line below it. So both lines extremely oversold. You can see the intermediate line's been dropping. It's actually still above the 50th percentile, but barring barring a move higher tomorrow or in the next day that replaces these two down days, you're going to get the intermediate line falling below 50, which will mean the first intermediate low point since this one right here back in August. And coincidentally, we are sitting on right now the 50% Fibonacci retracement of that intermediate move that we're currently ending right now. Well, eventually will end in the next day or two. You also see too, this line right here that we're trading around, this orange lines, that is the market sentiment move. That's the last time market sentiment produced a low point, this orange line that was below the 50th percentile. So we are just barely passing the 23% Fibonacci retracement of a very long extended bullish run, long-term bullish run that we're on right now. And you can see market sentiment's not anywhere close to being below 50. So that's why I don't think, again, that we're heading into a bear market per se. You can see, what they technically call a correction a 10% decline. We are now down almost 8%. So this is almost a full-blown correction in a matter of a week and a day. Bear market would be 20%, right? So it's been a sharp decline here, needless to say. But you also see that because it's been so quick, market sentiment line hasn't been able to, for that matter, catch up, nor really diverge. I mean, a little bit of a divergence. You can see this this long-term high with this low point right here at the beginning of the year. You can see, obviously, we have higher highs. That low point in between is kind of in this area here, right about where this 50% Fibonacci retracement is. So technically, we're sitting at the low point of the divergence showing up on the market sentiment line. So, I wouldn't be surprised, again, we don't bounce here. In fact, that's kind of what I'm expecting because of how extreme the selling has been. Here, let me move this line because we're still, sorry about that. Here we go. I want to move this down here because now we're still forming that near-term low point. That near-term low point is now below the last near-term low point. As odd as it may seem for that to appear, as unlikely as that was to it appear, we have dropped down to the previous near-term low. We had a bunch of them right here, but you can see we're kind of sitting in this area of near-term highs and lows right now at 2650. A little bit of pressure so far in the after hours. We'll see how much that follows through tonight and into tomorrow morning before tomorrow morning's open when more volume starts to come back in. So that's the S&P 500. Of course, the Dow Jones Industrial Average looks very similar, breaking below multiple trend lines, long lower shadow there, so finishing off the lows, whereas the S&P 500, you notice, did not finish sharply off the lows. The the Dow Jones Industrial Average did. You take a look at the NASDAQ Composite, it finished right at the lows, near-term momentum line extremely oversold, intermediate market sentiment posture dropping, extreme oversold short-term. You know, again, the odds of a bounce are getting higher and higher, obviously, with the bigger, more extreme moves to the downside. The question is, when do we get in? When do you follow? When do you add to your positions? Assuming that you probably have been stopped out of some of your later positions, maybe even stopped out of some of your older positions as you moved up stop orders. You can see why we talk about taking positions off, right? As stocks make their runs and the risk gets higher, because remember I've used the analogy of walking the tightrope across the Twin Towers. That's what we've been doing here in this area. And at that point, you have to take risk off the table, risk being on these older positions, your profits that you have in there. We don't have to take them all off, but we take some off, because what you're risking now, your stop order might be below support. You can see the last low point we had right here. We're actually still above that, but that's not our risk. The risk isn't what we could lose on the position. The risk is losing all of the profits that you gain. And of course, any new positions that you enter in up here, if you're position sizing normally, then this is a day like the last couple of days is going to really hurt significantly. And then finally, Russell 2000 also extreme lows, breaking below this significant low point here. It was an old high, retested in December, bounced off of it to new highs, to new higher highs, 1500, breaking back down below 1500. So pretty sharp. That's been underperforming already. Its intermediate line is already below 50. But again, its last intermediate low point that when it formed was back here in mid-November. We didn't get that on the other indexes. And you can see coming off of that low point, the Russell 2000 rallied. Now, granted, this is a lot of tax reform related moves here, but rallied 4 days off of that. In 4 days, more than rallied what it had lost across all those weeks. Again, tax reform related, and none of that's actually changed here. And we are now almost back down to where we were before a lot of those tax reform expectations started to get priced in to the markets. Now you notice the last time we've had such a significant drop this far this fast, when the VIX got as high as it did, was right here this week of the 24th, which you notice we had dropped below the 200-day moving average the week before, and we had dropped down sharply, well below the 200-day moving average before bouncing off of it with that long lower shadow and rallying. Now, obviously not up to that prior week's high, but you can see that was, look how far, that was, the MACD had been declining. We had finally broke the 200-day moving average, and things really picked up into that August 24th timeframe. And then you can see, boom, within a matter of a couple of months, we're right back up to where we were, 2100. So here, now, you can see we were so far up above the 200-day moving average that we still haven't even come down to it yet, right? So again, that just shows how extreme this move was this year so far, to get that far away from the 50, 200, and every other moving average we looked at. This 2-week decline basically just corrected all that excess. And again, bull markets don't die of maturity. Bull markets die of excess. And again, whether that was excess or not, I mean, those are some extreme moves, not just on an absolute basis above those long-term moving averages, but also on a relative basis when you look at it on the percentage terms. And again, hence the analogy of walking a tightrope up above the Twin Towers. Doesn't mean you can't do it. It just means that There's more risk there than ever, and to take the adequate safety precautions in case of this kind of a fall that we're getting right now. Nobody would have expected this. So no matter what anybody says, I mean, yeah, perma bears will probably say, see, I told you so, but they've been saying that for a long, long time. So nobody would have expected this 2-week decline, no matter how good you are, no matter what charts you're reading. And if you did, you got extremely lucky, right? Otherwise, the market would have already priced it in. Right? If they were expecting this, the market would have priced it in. There wasn't an event like a news announcement that was a binary event one way or the other. This was just, selling begets selling, and momentum builds on itself. And when you're that far up above, when you're walking a tightrope that high up, the slightest wind can push you off. The slightest wind. It doesn't have to be a big binary event that basically has to two-hand shove you off that line. The slightest wind can push you because you don't need that big of a jolt to fall very far. And so, again, from a valuation standpoint, from how high above the moving averages standpoint, from all those factors, technical and fundamental factors, we were walking a tightrope very, very high off the ground here. When you look at the 3 green arrows, you can see obviously we have 3 red arrows. We had 3 red arrows on Friday. We followed that up with a sharp, sharp decline. Again, right back down to that 50% Fibonacci retracement of this intermediate run that we're on right now. The MACD is just barely getting below 50, which means the 8-day moving average is now down below the 17. You can see this is our first big move below the 30. And when we're getting, we've talked before, we don't typically get these sharp declines when the MACD is that high. So don't be surprised if we don't get a sharp bounce too. Now, whether it'll be in a day or two, probably not because of the strong momentum to the downside right now. But don't be surprised if we don't get a sharp bounce back up in the MACD because of how far down we go. That's your typical moves when you're coming down from big MACDs. They're more grinding. So, that kind of a move with the VIX as high as it is. See, the VIX is very high right now. The VIX isn't low like it is when you're that far above the moving averages and it produces those grindings. Right now, the VIX is very, very high. So it's not like we're going to drop now and grind from here because that's not what the VIX is suggesting. The VIX is suggesting we're going to get another big move from here. It could continue to be to the downside. It could also be back up to the upside. But it's going to be volatile one way or the other is what that's suggesting. Now this chart will make you hold your breath for a second. This is the intraday chart, and you can see like Friday didn't even happen on the intraday basis because of data feed. But that was the high and the low on Friday. You can see we started down right on the 4-week low. This right here is the 4-week low point. We opened up on the 4-week low and bounced off of it, and even got up above on the S&P, got up above Friday's close. So we were up just a smidgen last week, but hit that high point, hit that last week's low point, which also was last Friday's low point, which happened to be the close of the week. We came right back down. You can see we got right back down to the 4-week average here, and once we broke that, we retested it. And then that's when it really fell. So when we broke that 4-week low, which we talked about, we typically don't do. So again, that's why the move has been so big. Because this isn't typical, obviously. Hopefully that's like needless to say. This is not a typical move. If it would have been expected, we would have had more of selling here. It would have been more gradual, but it wasn't. This is not. That's why we held that support. That's why we retested that new resistance, and then the wheels really came off. So that's how much now. I mean, now I have to move this line, which was the 4-week low point, and that was at the beginning of this 4-week period. You notice, so it was back over. Give it a second to load right there. That was the 4-week low point. Now this is the 4-week low point. And we're actually below that here in the after hours. You can see we're down to just over 261. You can see we formed a long lower shadow here on the hourly chart, then filled that shadow in the last hour of trading, last half hour of trading. And then a little bit below it, like I said, in the after hours. So big move. We have a big 4-week range now. Now, typically we get the big 4-week ranges at the bottom of a decline. And then when we get these big, we tend to bounce off the bottoms pretty sharply. I've said before that we typically don't break down until the range tightens up. We actually fell down a lot quicker here because of the last couple of days declines. And it really wasn't even before that. It was this last 2 days that was the biggest movers to the downside. Obviously, last Monday and Tuesday's open, we had already down just a little bit there. But it's in these 2 days right here coming down that's pushed us through into the lower half of the old 4-week range, and now opened up such a wide range there. And you can see on a entry, if we thought Friday's range at what, over 6 points with the gap was big, today's range, which includes the gap because we filled in the gap right off the bat and then came back down. Today's range is 12.5 point move. 12.5 point move on a 1 day basis. The volume was almost 300 million shares traded. We have to go back pretty far to get back to where we've had 300 million shares traded, and that was on Brexit. This was the Brexit move. The last time we had in this case we had over 300 million, and that wasn't even, that was 3 standard deviations up above here. And you can see we're well up above 3 standard deviations now too, well up above there. And you can see, just again for precedent's sake, the last time we had this much volume, we did go down another day, but then 3 days later, we almost completely recovered it. So, that's how quickly we bounced off of that, and the VIX was bouncing up higher too. And in fact, let's take a look at the VIX now. And you can see the VIX in the Brexit move got us up to 25. This is the highest close on a daily basis that we've had since that August 24th period of 2015. And again, right there is the August, excuse me, that's not it, it's going to be right here. Right here it says August the 24th, right there. August 24th was the last time the VIX has been this high. 3 days later, 1, 2, 3, 4 days later, we had more than recovered that. Now, we hadn't recovered everything, and we double bottomed before eventually coming up off that low point. But you can kind of see what happened. And we also formed a cluster, too, the next day on the 25th. That's the last time the VIX has been this high on an absolute basis. And if you look at it on a relative basis here, and here we go on an absolute base, on a relative base, we're up to 1.33. The VIX is 1.33 times. And again, last time we saw that was that August 2015 level. So we're seeing a few things here in terms of the VIX that we haven't seen for a while. And you can see the VIX eventually, within a couple of months, was right back below 15. But it never did get back below 12.5. Right, so we had a little bit of a higher volatility heading into the end of 2016. But remember, we kind of rallied until then, up to new highs there. And then, of course, the last time, one of the things I tweeted out today, the last time we've had a VIX move this big. In fact, today's move is a record 1 day % change for the VIX. The last time was 227 of 2007, and I talked about that before. This is a very similar period, how 2018 is going to be very similar to 2007, and that we're going to have higher volatility for this year, similar to what happened in 2007, how we got to jump up right there, 227. You can see it went up a few more days before pulling back down to 12.5. Never did drop back down to 10 or below. And then we rallied, and remember, the market actually formed its all-time high right there in October of 2007 before rallying. And that's much higher VIX than it was in February. So, and you can see how we had months of really small ranges, 2.5 points, and then bam-o, we break out with the biggest one-day move ever. So, again, very similar, very small ranges month to month, 4 points here, 4 points there, and then whammo, 27, 30 some odd point range almost in the month of February so far. And we're only, a couple of days in. I wouldn't say 30 points. So February we're looking at 12.5 to 37.5 to 25 point range on the VIX. Big spikes. Usually these spikes are short-lived, as you can see, and then we start to grind our way back down. So on Twitter, I retweeted a comment about now's the time to sell options because option premiums, according to the VIX, are very, very high. In fact, if you take a look at the S&P 500 right now here, Look at this is the straddle for the S&P 500 on the week. Now it's a little, you can see we're down to 261. You know, we were at 264 at the close. Then we're at 261 in the after hours. But if you take a look at the, you know, right now the bid price for both these options, they're very wide because it's very volatile right now in the after hour market. So very, very wide spreads. But if you're looking at the bid prices for both of these, we're looking at about a $20 spread, which means from 261 that we could go, there's the odds are that we could go up to 280, to go down to 241, but we can also go up to 281. That's how big that spread is. And just for, you know, just for some comparison's sake, if I were to go back just a few days later, and so not even the Friday, just a few days later here, let's go to the Think Back and we'll look up SPY just to show you how big of a deal that volume is. We'll go back to, let's go back actually to before the selling. Let's see, when did the VIX really start to take off here? Let's go back to February the 1st. It was high. It was up to 12.5, but then in the last 2 days it's taken off. So February the 1st. We'll go back to that one right there. All right. So now we take a look, and so that was the at the money straddle for the February options that are 9 days away. So if we were to go back to the Analyze tab and say, okay, let's bring this down. There we go. And go, let's see, this is 8 days away, so pretty close. And we'll look at the at the money straddle there. We closed that day at 281.5. So we're looking at $3.37 spread on at the money option, at the money straddle. That's 8 days away. Right now we're looking at $20 move up or down. It's 9 days away at the money straddle. So that kind of gives you an idea just how crazy the VIX is right now, and why we say now's a good time to sell options. You can see just the extrinsic value alone. If you were to say, okay, well, you know, what's if I were to go to that mid-30s delta, which is in this case would have been $2 away, mid-30 delta, $2 away, I would have got $1.27 of premium, you know, selling that option. If I were to go do the same thing here. So let's do delta, and we'll do, what was I looking at? Extrinsic value. Then change that one to extrinsic value. Right. Where's that extrinsic value? Oh, there's up there. So 34, well, let's go to 31 delta. So we can have some apples to apples here. So 31 delta, $1.12. I would have been $2.50 away on this spread, and $1.12 of extrinsic value. Here I am 31 delta. I am $14 away, not $2.50, $14 away. I mean, to the point where I'm $5 wide spreads here, because the market, I mean, they weren't expecting that to be here. So $5, so I'm $14 away, and I'm getting $4.86 of premium. $4.86 of premium for 9 days versus the same $1.12 of premium. So when we say now's a good time to sell options, that's why. Because the market, you know, here I've got $2.50 plus that $1.12 of wiggle room that this can go down and still finish out of the money where I want it to. Still finish at above break even. So again, $2.50 to the strike price, plus that $1.12 below it. So that's how much wiggle room I've got to work with. How much wiggle room do I have to work with here? $14, well, you know, $11 now in the after hours. $11 plus that $4.86 is almost $15, $16 of wiggle room that I have to work with before I hit break even on an option that I'm selling there. Just for an example, not that you'd sell the 9 days out, but that just kind of shows you an example of the benefits of selling options when the VIX is this high. You get a lot of premium, you've got a lot of wiggle room, and you've got time on your side to let things crazy out, and then eventually, you know, come back the way it's always come back in the past. All right, so now as we transition to what's driving the price action today, there's really only one thing. Before we get to it, from a news perspective, we only had one economic indicator. It was a very strong ISM services number. You know, that combined with the manufacturing keeps those GDP estimates strong. You can see it helped bring the Yardeni Surprise Index back up here, up above, up to 50, which, remember, was a very high level compared to previous peaks that we've seen. But it was what the main thing that's just driving this price action is a technical factor from the fact that yields have been so high, that we're hitting such high levels on yields, and that's putting pressure on stocks. Again, if you take a look at the 10-year note yield, which had hit 2.8% late last week, back a smidgen down below 2.8%. A little bit of a harami so far. Here's the daily chart, what the daily chart looks like. A bit of long upper shadow forming there. Very far up above moving averages. If I were to look at this here, let's go back to a 5-year and take a look at the on the signal chart here. You can see very far up above the 8-day moving average. I mean, this is what the stock market had looked like, right? We saw what the stock market just did. So if you see yields come down like this, since that's what put pressure on stocks here over the last few days, you would say, okay, well, at least the initial drop to overcome all this will help stocks find a bottom. But again, if this continues down to 2.6%, then that's probably what's going to give you a good bounce back up in stocks. Break below 2.6% will be bearish for stocks, right? So we talked last week about the possibility of this dropping back down to 2.6%, and that kind of giving the impetus for a jump back up, a short-term bounce. Not up to new highs in stocks, especially now not up to new highs in stocks. Even though, for that matter, again, we talk about how, you know, we're hitting the 50% Fibonacci retracement. The odds of a bounce up to new highs are still decent, right? They would have been better if we would have held at 38%. If we would have held this 2,700 and bounced, much better odds of bouncing up to new highs. But we didn't. We were down to the 50%. You still have decent odds of bouncing to new highs, even though that's not what I expect whatsoever. We're just going to get more near-term volatility. Here's a situation of this, and now with the VIX as high as it is, and what's driving this action, and we expect this to, I expect it to be just as volatile now to the upside, at least in the short term. You can see stocks have been the biggest losers, really from the close of the Friday before. So including all of last week and then today, stocks are down almost 8%. From those highs. So now we've got our 5% drop, right? We hadn't had that before, and now we do. Now we have our 5% drop. You can see bond prices were dropping along with them, and that was what was pushing stocks down. But now bond prices have found their bottom and look like they may be bouncing up, and that might help stocks eventually find their bottom and bounce back up too as they lag behind a little bit. The dollar is strong. The dollar is acting as a safe haven. So is gold. So gold's up or only down 1% right now. The dollar's up 0.5%. You can see treasuries are almost back up above high yield, and you can see high yield, holding their value very well. So this is an equity market sell-off. It's a technical sell-off, breaking below that 4-week range I showed you. You can see how it held for support and bounce. Breaking below 50-day moving averages. This is a technical, and breaking below the 50-day moving average, not the 200-day yet, but breaking below that really has added a lot of selling pressure to all of this. There's not a fundamental basis yet for this. There was that intermarket relationship with bond yields, but you can see how it's found its bottom. And so again, considering stocks lag behind bonds prices, you would expect stocks to find their bottom here. At least, again, only in the short term. I do not expect that we'll continue to trend higher. I still do expect a decent return for 2018 based on everything we've seen in the past. I just expect 2018 to be a year of increased volatility. And so far in the first few days of February, that is definitely playing itself out and providing opportunity, as I showed you, on those S&P options chains for selling now because of how much premium you can get at these low points right now. From a sector rotation standpoint, you can see the sell-off has been broad-based. In fact, let's just go now to 2 days. So this is when things really have hit the fan, right? Over the last 2 days, down over 6%, 2 days alone. Energy has been the biggest dropper, down 8%. Now, if you recall, go back, previously, Energy has been a big gainer. Was up 22% in a 6-month period, or less than a 6-month period. Now it's just giving back a lot of those gains. You can see over that same 6-month, utilities and real estate struggling and lagging behind. Consumer staples as well, sharply lagging behind. So you can see again, utilities and real estate dropping still, but not nearly to the extent as a broad market. So half or better of the losses that the broad market's getting, because again they have their value there. And you can see even consumer stocks, consumer discretionary and consumer staples out beating the market. Still down quite a bit over 2 days, but still beating the market. Everything else pretty broad-based. Technologies, industrials, materials, healthcare. I mean, even consumer staples, all this following the broad market down, following its former leader down, with its losers holding their value a little bit better. And so there's going to be some opportunity in these areas. And you'll find when you get the email with the clusters, that you still have a lot of clusters in the utilities and the real estate sectors. So there's going to be opportunities, especially with pretty decent yields now after such a big sell-off in these areas. There's going to be some opportunities as we rotate in and out of different areas, rotate in and out during a time of higher volatility. All right, for our trade idea of the day, I want to take advantage of this high volatile move. Now, we've looked at this stock in particular before for a calendar spread with that earnings announcement, trying to take advantage of the high volatility on the week of earnings, selling it off against a back month. Where in this case, that back month has held its volatility pretty well. Not as much of a volatility compression, and for one reason, because we really dropped a lot further than that strike, and that's why that kind of a spread is very forgiving, because that volatility, if it keeps dropping below your strike all the way through the other side, volatility stays pretty high on that put that you bought within the calendar spread. But now we're going to take advantage of a new trade idea, take advantage of this volatility that we have right now. You notice it's still very high even after the earnings announcement. A little bit of a inverted hammer pattern here with a long upper shadow today. Not as bullish as the long lower shadow would be, so we don't want to read too much into this. But there may be some opportunity to buy a company which is down, well off of its highs. A solid company. It's got some weakness lately with iPhone X orders, and of course Apple's had its ups and its downs. But you can see it's pulled back and it's offering opportunity at a much cheaper price, because we always talk about how we want to buy the dips. Okay, well, let's buy the dip on Apple. But who in their right mind would buy this company right now, right at 156? And again, maybe you still are in it and you're looking to do something without having to sell it, because, again, who would want to sell at the low point? Even though it could be who knows where the low point ultimately will be. But we're going to look at this for an opportunity. So we can say, okay, well, let's look at selling. Take advantage of this, because we talked about selling options is something we can do. Let's look at selling that 39 days out. Now, wait until the market opens tomorrow to see what these prices turn into when there's more liquidity. Right now, there's just been very little liquidity with the market moving as big and fast as it's been doing. So those spreads will tighten up as things kind of start to normalize again. But we'll take a look at this for an example. And you can see right now you're getting about $3.55 for a 33 delta. That's where the stock is about $6 away, at least in the after hours. Compare that to back when volatility was low, back here in December, on December the 7th. The last time volatility was low, December the 14th. We'll take a look at a similar delta, 39 delta, so actually a little higher delta. And you notice I'm only getting 267, and this for a strike that's only $2 away. So 267, and where now I'm getting 355 for a much lower delta, 33 versus 39, for a strike price that's much further away than where the stock is trading. So you can see the benefit of premium. I got more wiggle room. If you take a look at where 150 is here, you can see there's some ups and there's some highs and lows in here, some resistance and support that can help hold this stock in this area if we were to continue to drop. And again, if you already own the stock, you're basically reducing cost basis by $3.55. If you don't own the stock, you are now buying the or selling. You eventually will have the obligation to buy the stock at $150 if the stock keeps dropping and you allow this option to expire in the money. Obviously, you can roll it to the next month at 150 and just keep rolling it as the stock, if the stock were to continue to drop. You get more credit as you roll through more time. If you have to move your strike, you might have to pay more money and lose some of your credit that you received here initially of 355. But again, trying to take advantage of this high volatility, looking to buy the stock, maybe not now, because the chart, I mean, this does not look like it's a buying opportunity at all right now. But if it were to hammer around here and mess around with the support and then bounce back up, as you typically do when volatility is high, again, you tend to bounce back up a little bit and volatility comes down. Okay, well, if that's the case, then once it starts to bounce back up, then I can start looking for buying opportunities and buy signals. But I've got, at least in the meantime, $3.55 of return already before I even buy my first share. That's the benefit of selling puts, and it's the benefit of selling puts when volatility is as high as it is on a relative basis. So again, thank you very much for watching tonight. I appreciate the time that you spend watching these videos day in and day out. Hopefully, especially on a day like today, you get some value out of it that helps you make sense of what's going on, that helps you find and see those opportunities that a crazy day like this can afford to investors and to traders. So as always, remember to like, subscribe, and comment on the video down below. Follow me on Twitter for more content throughout the day, as well as join the Market Outlook community on Facebook with everybody else that's watching these videos. So again, have a great evening, everybody. The market's been going haywire today, but usually when it goes haywire, things happen. So we're going to always continue to break this down. So stay tuned, and we'll see you all tomorrow.